Hello, everyone. Welcome to this month's edition of Markets Monthly Strategies and Perspectives. My name is Gary Quinzel. I'm the VP of Portfolio Consulting here at Wealth Enhancement Group. And as always, I'm joined by Yoshioka, one of our senior portfolio managers. Let's go ahead and dive right in. So we're going to start off by sharing some of our perspectives and insights from our roundtable. Equity markets rebounded pretty nicely in May, coming off their April lows. Some of the rationales or the reasons behind that rally had to do with some really solid corporate earnings that we saw out of corporations in the first quarter. We also made some observations recently about some very impressive corporate buybacks, looking at some of the cash flows that have been reported from some of the sell-side wirehouses, really seeing some impressive support there that's helping boost equity markets, at least in the short run. So definitely risk on has been the story the last several weeks. Certainly a different narrative from what we've experienced a few weeks prior to that when we did see a little bit of a sell-off leading into April. The reason for that has a lot to do with expectations from the Fed. So what we've observed, and we'll talk a little bit more in a bit, is how inflation has been coming in softer than expected. We did see around 3 or 4 months in a row where inflation was surprising to the upside. That has definitely shifted. We're now seeing more evidence of softer than expected inflation, helping set the stage for a more accommodative Fed in the near term. And right now, we've seen a lot of fluctuation in expectations for rate cuts coming out of the Fed. Right now, we are looking at expectations for rate cuts in the latter half of the year. Finally, another key talking point that we want to touch upon has to do with the labor market. And so we did see yet another very strong job report last month, demonstrating that continued resiliency in the market. However, some economists and market participants have highlighted some potential catalysts that could mark a turning point in the overall labor market. But when you take it all together, we look at a number of factors, whether it's economic growth, retail spending, overall health of the corporate market, and of course the markets themselves. We really do continue to be on this trajectory of a soft landing. And that's been just very supportive of both fixed income and equity markets. And so we continue to have belief that, right now, the path of least resistance does seem to be trending higher. And with that, I'm going to hand it over to Aya. She's going to talk a little bit about some observations from the markets in the month of May. Aya?
Thanks, Gary. Really appreciate that. So as usual, we'll go through sort of the numbers here for the month of May. And as Gary mentioned, we saw a nice rebound. As you remember, in April, we had a little bit of a pullback in markets, but we had a nice rebound during the month of May with a lot of the tech stocks, again, leading the charge. The NASDAQ 100 was up over 6% during the month of May and bringing the year-to-date total to over 10.5%. However, it's been a pretty broad-based sort of recovery across most markets. So it's not just US large cap tech stocks that are in the lead there and doing well. We are seeing, a good rebound in US small cap stocks. And we saw international and emerging market stocks, at least in the green this time around during the month of May, which was nice to see. On the bond side of things, yields did come down during the month of May, and so we are seeing some positive returns there across most markets, except for within the muni landscape. And then lastly, the commodities and the REIT index. Again, the REIT index being very correlated to interest rate movements. We saw that as interest rates came down, the REIT index performed well. And then same with commodities. Commodities have been doing well despite the fact that inflation expectations have started to come down a little bit. If you go to the next slide, as Gary mentioned earlier, we did have a great end to the overall first quarter 2024 earnings season. And earnings are really sort of what we believe drive the underlying sort of value of the equity market. And as you can see across all the sectors, you can see many companies did surprise to the upside in terms of what was expected by Wall Street. These numbers led by the communication services sector and some consumer discretionary stocks did very, very well, surprising most analysts to the upside. On the flip side, we had some energy companies that I think the Wall Street analysts were expecting sort of higher numbers there, and they still surprise to the upside, but just not as much as they had in the past. If you go to the next slide, the other thing that we saw during earnings season was the amount of corporate buybacks that have been announced during the last few months here. And I want to point out, just Apple alone announced a $110 billion stock buyback program. And so just Apple itself constitutes a little over, a third maybe of the bar that you see over to the right-hand side. And many of the tech companies are generating lots of free cash flow, which allows them to buy back their stock and announce programs like this. If you go to the next slide. Yeah, I think that's it for me.
Thank you, Aya. Yeah, it's really interesting, this observation about corporate buybacks. I feel like it was a big story last decade, right? Especially when interest rates were really low. And so I think now that it's coming to the surface again, we're seeing, this reach kind of levels that we haven't seen in a long time. It just reminds us that they haven't gone away, right? But they're also very cyclical, as this chart demonstrates. And so I think we're coming into a blackout period once again pretty soon. So it'll be interesting to see how that shapes up.
And that's a great point that you make about interest rates, though, too. The interest rate sensitivity and the amount of companies that can buy back their stock, is probably shrinking a little bit now that interest rates are higher. But when interest rates are a little bit lower, everybody was sort of buying back stocks for sure.
Absolutely. Yeah. All right. Sounds good. Let's move it on to talk about some economic highlights. And so we can't have an economic discussion without talking about inflation, right? Because this has been the story of the last couple of years. And we've used this chart in the past. I think it's really relevant just to talk about how far we've come in such a short amount of time. And so as a reminder, the difference between core inflation and headline inflation. Headline is consumer price index, includes everything, right? And then core, what they do is they take out food and energy. And some people might ask, why do you do that? I spend a lot of money on food and energy. Well, the reason that we do that, or the reason that economists do that, is because it's more predictive of where inflation is going in the future. It's also not as volatile. So it doesn't go as high, usually doesn't go as low. All right. And there's another element that we don't have on this chart. It's actually called super core inflation, and it strikes out other elements as well that have been really support or demonstrating some of the inflation that's really sticky, and it's been really a challenge for the last several months in terms of trying to get inflation back down to 2%. Super core inflation has been extremely sticky as well, and we've had some elements, especially services and insurance, that have really been very problematic and really the main reasons, the drivers of why inflation hasn't gone down as much as we'd like to see it. That being said, as I mentioned earlier, inflation overall has continued to decline the last few months. That's certainly a positive sign, something we can all enjoy and are happy to see, and a little bit relieved when we go to the pump or when we go to the supermarket or just when we go to get a haircut. We all want to see this come back down to 2%. But the super core element, those really sticky elements, those services, they just don't want to go down that fast. And so we've made a lot of progress, but we haven't gotten all the way there yet, which is why the Fed has been a little bit slow to cut rates, right? A lot of people are very anxious for the Fed to cut rates, but they haven't done so because they don't want to cut rates too soon. The other big thing that the Fed is looking at, of course, is the labor market. And in the first week of June, we got yet another very strong payrolls report, as this chart demonstrates. So the dark blue bars are the month-over-month change. And you could see by looking at this chart that the month-over-month change is notably higher than the pre-COVID average, which is right around 175,000 jobs per month. And so we've continued to see an upward trend. That dotted orange line demonstrates the trend line, the 3-month moving average of payrolls, and it's been trending higher. So really supportive. It's giving the Fed some cover overall. And so we've just continued to see this resiliency, and that's what's been quite astonishing over the last 18 months. If you think all the way back to when everyone was predicting a recession, the labor market has just not fallen apart. And we think a big reason for that has to do with immigration. There's been a notable increase in immigration, which has actually helped push payrolls higher. There's a little bit of a divergence going on right now between payrolls and the household survey. But overall, we've continued to see a lot of resilience here, but we are being very cognizant of when and where, or when and why we might see a shift in overall the labor market. And one observation is the overall unemployment rate, even though payrolls went up, the unemployment rate has actually hit 4% for the first time in about 2.5 years. Now, while that's still very, very low, it is one indicator that we've reached a higher unemployment level. Another very interesting indicator is if we look at the comparison between job openings and the number of people looking for those jobs. What we can see on this chart, the dark blue line is the number of unemployed people. We see it spike up during the pandemic. The green line is from the JOLT survey, and that represents the number of job openings. And so for the longest time, there was always more unemployed than those job openings. We saw that crisscross in around 2018, and then we saw it majorly crisscross again coming out of the pandemic. But what we've noticed is the quits rate has come considerably down. There's just not as many job openings. People aren't changing jobs like they were back in 2021. When we do see that those lines cross, that will then once again mean that there's actually more people looking for jobs. And so that may or may not be the most decisive indicator, but it's something that we find very interesting as we're looking at the labor market, trying to absorb that information in terms of how it impacts consumer spending, which makes up a big chunk of the economy, and how that's going to impact the Fed's next move and when they might make that move. And so with that, I'm going to use that as a segue and ask Aya to talk about expectations for rate cuts coming forward.
Thanks, Gary. Really appreciate that. So I love this chart. It is a chart that tracks the expectations for the number of rate cuts for 2024. So if you look at the left-hand side, we start around 5, meaning that markets expected 5 rate cuts back in June of 2023. So as we went through the year, at the lows, the markets were only expecting close to 2 rate cuts towards the fall of 2023. And then the Fed came out and actually added an extra dot in their dot plot back in October of last year. And that created a market environment in which everybody went a little too far and expected almost 7 cuts from the Fed in 2024. And because the inflation data and the economic data has come in stronger than I think people expected, that has had to get wounded back. And so we're now at, again, 2 cuts for 2024, maybe 1.5, but we'll see. Either way, I think the message is that we are going to have, or are likely going to have, a cut sometime later in 2024. If you go to the next slide, one of the other things that I wanted to sort of point out, and this is a great little pie chart here, we talk about the Mag 7 many times. We've talked about concentration in markets, and everybody knows, if you turn on the news, artificial intelligence and AI, ChatGPT has been everywhere for the last 16 months or so. And NVIDIA's chips are sort of everywhere in terms of powering all of this AI going forward. NVIDIA has had a stunning run over the last 2 years or so. And you can see that through June 11th of this year, the markets are up 13.2%. And of that 13.2%, almost a third of that comes strictly from one stock, which is NVIDIA. If you look at that teal portion, which is 43% of this pie chart, that's the next contributors, the stocks 2 through 10 within the S&P 500. And so in conjunction, the first 10 stocks within the S&P 500, or the largest 10 stocks there, have contributed over 75% of the index's performance year to date. So it's a pretty stunning metric to see, especially when you single out NVIDIA. And in the first quarter of 2024, the overall earnings growth for the S&P 500 was 6%. So that's solid earnings growth. But if you exclude just one stock, again, if you exclude NVIDIA, the earnings growth was only 3%. So you can see how much NVIDIA is impacting the overall S&P 500's performance. If you go to the next slide, one of the other things that we did learn during earnings season is a lot of commentary from many multinational companies. We're talking about improvements that they're seeing overseas. And we've talked about international and emerging markets for years, and valuations have always seemed a lot more attractive relative to US valuations. But one of the things that we're really starting to see here is just some economic activity that is picking up outside the US, while the US has seen a little bit more moderation, as Gary talked about, whether it's moderation in overall GDP numbers or moderation in inflation that's keeping the overall economic readings slightly below the expansionary readings of 50 on the index. So you can see here for both Canada and the US, we are below that 50 level, which indicates expansion. So under 50, it's slight contraction. But a lot of the other areas across the globe are seeing some improvements in their overall global manufacturing activity. So we like seeing that. We like seeing that and hearing the commentary as well from many of the companies that we listen to on earnings calls. And we think that that's a great thing to see when we talk about the broadening out of overall markets, especially when we're seeing some concentration at the levels that we saw, as I mentioned in the previous slide.
Thank you, Aya, so much. And I think, look at a little echo there. I think it's really interesting that, how the ECB already cut rates, in June, a quarter of a percentage point down to 3.75%. And they are on a path to lower rates, more so than here in the US. Not to guarantee that that's going to happen, but that is sort of stimulating some more interest in potential, more accommodative conditions. So yet just another a factor to consider, and it has broad implications across equities, fixed income, currency, something we're paying a lot of attention to. So with that, I'm going to wrap up here. Equities, as we mentioned, firmly rebounded. Once again, we're back in or near record high territory. And as we mentioned, the path of least resistance does appear higher for the short run. Doesn't mean it's going to stay that way, but we are seeing a lot of positive momentum going on right now. A lot of moderately good growth numbers that are supporting the story, whether you're looking at it from a soft landing perspective, an outlook for more accommodative monetary policy. We're continuing to realize and experience and appreciate all of the fiscal tailwinds that are making their way through the economy. A lot of growth in spending and infrastructure and semiconductors and construction overall. So there's a lot of tailwinds happening right now. It's being very supportive. We're still seeing the economy expand, and that's happening at the same time that inflation is coming down. So it does put us in a good situation. We have moderating inflation. We have strong labor market growth that's still expanding. We just had another month of positive retail spending. So definitely puts us in kind of that Goldilocks territory. Doesn't mean it's going to last forever, but it is reason to be positive. We do expect interest rate volatility to continue, though, because we don't necessarily know when or when rates are going to go down and how much they will go down by. As Aya mentioned, there's been a lot of volatility in terms of expectations of when that first rate cut will happen and by how many rate cuts. And also, we don't know what's going to happen with the rates on the longer end of the curve. They've been the 10 years hovered around 4.25 for a little while now, but there's no guarantee that that's going to stay that way. So where do we see opportunities? We like risky assets. We like equities in general. They look attractive based on those fiscal and monetary tailwinds. As I mentioned, we think there's a lot of opportunities overseas as well. You can't just be focused solely on the US, especially as corporations themselves are talking about these emerging growth opportunities. We like fixed income because we think that you can lock in more attractive yields than you could in over a decade. And if you look at where the 2 and the 10-year Treasury yields are, they're still at highs not reached since 2007. So just being able to lock in those yields and have that margin of safety, that's really attractive to us. And finally, we always think it's important when to look outside of traditional stocks and bonds if it's appropriate for your individual situation. Not everyone necessarily needs non-correlated assets, but it's a great way to lower the overall volatility in your portfolio and add things like yield and capital preservation. And there's a whole variety of different investment strategies that can be customized to help fit your unique objectives and preferences. With that, we highly encourage you to reach out to your financial advisor if you'd like to learn more about any investment opportunities or any of the things that we talked about. We thank you so much for joining us on this edition of Markets Monthly, and we hope you have a great day and a great week. Thank you so much.